Wes Stark, I haven't introduced myself yet, Managing Director, Risk Management Advisors. And let me lead with this, but definitely anyone feel free to jump in. This is just off the top of my head, the things that I'm seeing in dealing with potential captives that we're setting up. And one thing we're seeing a lot of, and we talked about it before, is group medical stop loss. That's become a bigger and bigger focus for many of our clients because the cost with the Affordable Care Act, there's some reasons, some systemic reasons why, not political reasons, why the health insurance is a failing system. So they've seen their premiums go up every year from 14 to now. And a lot of people are saying, you know what, this is bad and we need another solution. So I'm seeing a lot of that. We're also seeing some interest with the cannabis business. Cannabis businesses are looking for captive insurance solutions because although states have approved captives for cannabis and it's legal, recreational and medicinal in many different states, it's still illegal federally. So a lot of the traditional carriers are prevented from coming in and offering coverage. And if they do, because they're not admitted companies, when you have very few companies that are writing, for example, D&O insurance, directors and officers, when there isn't competition, then the insurance companies are free to charge whatever they want. Because a lot of these cannabis businesses, they get private equity investments. So they want good people on their boards, but no one's going to sit on the board of a cannabis business without directors and officers insurance. So, I mean, we've seen situations where you're getting $1 million worth of coverage and your premium's $350,000 a year with a $250,000 deductible. So should you have a claim for $1 million, the business is really covering the first 600 of that million anyway. So I'm seeing a lot of momentum in that area. We're still on the tail end of COVID. And, we have a lot of clients that put in business interruption insurance claims in their captive. And while the other traditional insurance market wasn't covering it, their captives did, because we've covered viral and bacterial events since 2015 or 16 with MERS and SARS. So we still have clients that are submitting claims for those, and they're wanting to come in and buy business interruption insurance because of their experiences. They didn't get anything when their business is shut down. Now that they're profitable and their businesses are open again, they're saying, you know what, I don't want to suffer that again. So can I set up an insurance company to protect myself for this business interruption due to COVID? Max mentioned before about the hardening insurance market. And a lot of people think that it's because of COVID, but I have some videos out on YouTube that talk about the hardening market, but really the market was hardening from Q4 of 2017 to now. The insurance industry was in a soft market and they really underpriced their insurance for a 7 or 8 year period of time. So then once they were hit with some claims, the capital and surplus has been decimated. Now the insurance companies are having to charge more money, and it's predicted that they'll have to charge upwards of 30% more per year for the next 5 years just to get to where they were capital and surplus wise before the pandemic hit. So I'm seeing with that hardening market and increasing premiums, clients just looking to say, okay, what can I do to protect my business? And then I'd say the last area, and this may be an area we want to dive a little bit deeper in, is cyber coverage. With more and more employees working remote or working from home full time, there's more intrusions and potential intrusions into a business's computer system or if it's a doctor or a hospital, their medical record system. And cyber crimes have been on the increase. And I actually have seen it on the news because of the current situation with Russia and Ukraine, the amount of Russian hacking that's going on and the amount of cyber claims that are coming out as a result of that. So these insurance companies, they're charging more and more money because they're having to pay out more and more money. So we have clients that are looking and saying, you know what, our cyber insurance has gotten so expensive, we need some other solution for it. So those are just some off the top of my head.
And I think, on the cyber front, it's also tough to predict how coverage will be determined, how claims will be determined. When cyber first came out, it was, charging a low or medium premium for something that ultimately didn't cover very much. And, you had angry, policyholders, and, because the underwriting hadn't caught up with what, cyber coverage actually was. And then, the carriers went out and staffed themselves with, people that were familiar with the technologies, IT folks, that understood the policy forms that they were writing, but then, somewhat inadvertently, perhaps started giving away too much coverage or covering too many things, not anticipating the frequency of, these ransomware or other cyber attacks. And then so now you have this pendulum swinging back the other way of, oh, wow, we got to charge more premium for this policy, and then perhaps also, restrict coverage. So, that's a lot of shifting sands for an insured to deal with. So, even if you're purchasing some level of cyber coverage in the traditional market, either utilizing some wrap coverage or deductible coverage in the captive, makes sense, even if you feel like you've procured the adequate limits. So good point there, Wes. The other thing I've seen is really a proliferation of warranty captives, especially in like emerging technologies. So, you've got healthcare, fintech, EV solutions. You have all these companies coming online with these quote unquote disruptive or emerging technologies, and they're looking to warranty their results. They want to get users to adopt their product. They want more, access to, private equity funds or investors. And then so they're looking to create warranty solutions, that backstop their product. Wes, maybe talk a little bit about some of the EV projects that you've worked on, if you can.
Yeah, no, I can talk about it because even though they're publicly traded, they had press releases and everything else. But the end of last year,
that was a big deal. I thought you did that.
No, their PR people did it. No, but we did an electric vehicle battery warranty product last year for a publicly traded electric vehicle battery company. So the first one to market, and because when you look at an electric vehicle, it's basically a motor and a battery, but the companies, whether it's Tesla or Chevy Volt or whoever, they only protect, or they only insure the battery for a very short period of time. So it's 6 years, 8 years, 10 years, but they also limit the amount of mileage you have on the car, just like any extended warranty, but there's so many exclusions. So if you charge your battery too often and it degrades the amount of power that battery can hold, they reserve the right to say, no, we're not going to fix it. And if they do, all of them across the board say, we'll replace it with a battery that has the same capacity. So let's say your Tesla, I have a Tesla, 2015 Tesla, and right now my battery is it's less than 70%. It's about 70% of what it was when I bought it. And if I went in to replace that battery with Tesla, they'll give me a battery that's 70%. They wouldn't go all the way back up to the 100. So that's what this company's doing, is coming in and supplementing and augmenting the current battery warranty that all these companies have. But it was a really interesting project, and I got to learn and go really deep on EV batteries because of it.
Yeah, no, that's exciting. So, I mean, warranty captives have been around forever, but it was always furniture manufacturer or the extended service contract. But these are, new twists on sort of old programs with the technology.
It is worth mentioning that I think last year was potentially the best year ever if we're in the captive industry. I know it was one of our best, and in talking to our peers, the interest in forming new captives for all the hardening risks like Wes just mentioned, for the unknowns, right? In what shape is the next disaster going to come, and not being able to predict that, having a captive, building the ship before the flood comes makes a lot of sense. And I think the general consensus is that tax rates are going to go up, and our clients are in very difficult tax brackets, and having this insurance structure creates a more efficient tax regime for them. So for all those reasons, it's created a lot of nice tailwinds for our industry.